I'm joined by Julian Callow, Chief European Economist at Barclays Capital. Good morning. Thanks very much for coming to speak to us. So you've described Greece's emergency bailout as a defining moment in fiscal policy. Why?
Well, I think it's the first time we've seen the countries in Europe come together with a deal like this for Greece. I think it is very important. It does buy some time here for Greece. It sets something of a firewall around Greece, which is very important because I think countries like Ireland and Portugal and Spain need to actually move a lot quicker still in order to reduce their deficits and avoid the risk of default creeping into their debt market. So I think it's very important that we're seeing this. At the same time, it's just an enormous challenge that Greece faces. I don't think really we've got an example, historically at least, not in the post-war environment, where we've seen a country achieve such a large amount of fiscal consolidation as Greece is planning to do. And it's still doubtful, really, just how far they can push that.
And given the enormity of this challenge, is the crisis necessarily over once this bailout package is signed, sealed and delivered?
I think when we think about the bailout package, we think about 45 billion euros, 15 billion from the IMF, another 30 billion from the euro area governments making loans to Greece. Potentially it could be 90 billion. If you're talking about a 90 billion euro package, which is over more than just 1 year, then that could achieve and secure the financing for Greece over at least a 2-year period to getting into 3 years. So certainly it removes the liquidity problems that have been confronting Greece. It certainly allays fears of a near-term default or debt restructuring for Greece. The problem is just much longer term because the arithmetic is so horrendous that Greece is facing here in terms of having a debt-to-GDP ratio that is 115%. It might get revised up.
And those debt problems are going to remain even after this bailout package comes into effect. And with that in mind, there are now those who are saying that the 45 billion euros may not be enough.
Well, that's right. That's why they may well need to extend it to 90 billion euros. And then you're talking about an extremely large amount of aid that is actually going to be going to Greece from the other countries in the euro area. And as I say, the debt-GDP ratio, currently 115%, that could well be revised up to over 120% of GDP. That is still going to be escalating when Greece is still generating these very large deficits from year to year. The problem is the starting point that last year the Greek general government deficit as a share of GDP was 13.6%. Even that may get revised up a little bit more.
It has already, hasn't it?
It was revised up last Thursday from about 12.9% to 13.6%, and then it's could well be revised up to something like 14% still. Now, you're talking about needing to change that into a fiscal surplus. You're talking about an overall fiscal adjustment that needs to be about 15% of GDP here to create the conditions to stabilise the debt-GDP ratio and start bringing it down.
And how difficult is that going to be, given that there's already been a great deal of opposition to the austerity measures they've already implemented, and the EU is saying that doesn't go far enough?
We're just at the very early stages of the fiscal adjustment, and already we're getting a lot of strikes. But in a way, although you know, maybe it's hard to think of it this way, but it's just really the low-hanging fruit that the government is able to achieve at the moment. It's got to go a lot further here if it's to achieve its targets and achieve
the prospects of default?
Well, the problem is that the markets are just not going to rule out the risk of default or debt restructuring until we see Greece generating a primary surplus well into the positive territory as a share of GDP. And that requires an enormous effort that we may not actually see Greece be able to achieve. So the market scepticism, I don't think is going to go away, even though this does act as a firewall. It does plug the gap somewhat. And as I say, crucially, it gives countries like Ireland, Portugal, Spain more time to achieve their own fiscal adjustment, and it puts an umbrella over these other countries.
Well, thank you so much for your thoughts, your analysis. We do appreciate it. Julian Callow, Chief European Economist at Barclays Capital.